The three stocks I'm about to cover are on sale from both a fundamental perspective and a technical perspective, meaning they are substantially below their 5-year average PE and below the average price over a 5-year period. Better yet, they're in three different sectors. The first stock that's on sale is UnitedHealth Group, trading at a trailing 12-month PE of only 18.4, which is 19% below its own 5-year average PE of 22.7. Their valuation is low. Meanwhile, their fundamentals continue to grow. Their revenue has increased every single year since 2014 and has grown rapidly by a CAGR of 11.1%. That's even better than Microsoft over 10 years with a CAGR of 9.3%. Better yet, their EPS has grown by a mind-boggling CAGR of 16%. From a technical perspective, they're poised to reverse, coming into a prominent 5-year support level around $430, and the price is far below average, depicted by the center standard deviation channel line, or roughly 31% below the average price for the 5-year period. Finally, the RSI being near the bottom of the channel indicates an extremely advantageous buying point from a risk mitigation perspective, and is likely set to reverse. A word of caution though, UnitedHealth is reporting their earnings on April the 16th, which will likely cause meaningful volatility. The next stock that's currently cheap is the Hershey Company, trading at a current PE of 20.5, or a discount of 23% based on their 5-year average PE of 26.6. Hershey, like UnitedHealth, has also grown their revenue every single year since 2014, although at a much slower rate, at a CAGR of only 4.2%. Their EPS tells a much rosier story, having grown by a CAGR of 9.2%, which is a function of strong margins and substantial share buybacks. If you want to see a deep dive on the Hershey Company, check out my full analysis linked below. Here we have Hershey over a 5-year period. The price is near a substantial support level around $182 and is far below the average price depicted by the center yellow line, or roughly 22% below average. The RSI also indicates a favorable buying point, being near the bottom of the channel. The last stock we'll look at is Nike, which is cheap compared to its own historical average, but expensive on an objective basis. Nike's current PE is 27.1. And according to Seeking Alpha, their 5-year average PE is 41.9, but that seems suspicious. If we look at Simply Safe Dividends, their 5-year average PE is 32, meaning Nike is at a current discount of 15%. The revenue has grown by a respectable 6.2% over this period and has been very consistent. Their earnings have been a bit more volatile, but have grown even faster than revenue at a CAGR of 9.0%. From a technical perspective, on a 5-year chart, they look to be bouncing off a prominent support level of $90. They are roughly 25% below average, shown by the distance from the center yellow line. Lastly, the RSI just reversed, bouncing off the bottom of the channel. On a side note, each one of these companies are dividend growth stocks with high 10-year growth rates and amazingly low payout ratios, with UnitedHealth being the lowest at only 26% and Hershey being the highest at 59%. Let me know which stock you think is the best deal of the group. If you want to see another video of a stock trading at a great discount, check out this video. Thank you for watching.
I'm not a financial advisor, and this is not financial advice. This is for educational and entertainment purposes.